In this video, I'll review the 5 best Vanguard funds to buy and hold forever. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, a channel dedicated to helping the San generation master money and achieve financial security. As I mentioned in many of my other videos, I believe that for the everyday people like us, index funds are one of the best ways to grow our net worth and achieve financial security, and ultimately, financial independence. And the longer you hold on to them, the greater the probability that these amazing assets can turn you into a millionaire or even a multimillionaire. So let's get right to it. Number 1 on our list is actually not a specific Vanguard fund, but a type of fund, and more specifically, fund of funds, called the Vanguard Target Retirement Funds. If you're just getting started in investing and not sure where to start, I believe that these are excellent choices for beginners. I get more into the details of target retirement funds in this video here, but in a nutshell, target retirement funds are simple funds that automatically diversify and allocate your investments for you based upon when you plan to retire. In the world of investing, you hear these terms often: diversification and asset allocation. They essentially refer to the importance of spreading your money around as much as possible so you are managing your risks effectively. Think of it like a healthy, well-balanced diet. You don't want to eat just only protein for your meals or only carbs. Your diet will be completely unbalanced. In a similar way, by well diversifying your investments within an asset class and across different asset classes, you're ensuring your money doesn't depend on one company or one type of investments to grow.
Then one day I got bored and I took all my money and I bet it on the Jets.
Many people who enjoy learning about the stock market and investments like to manage their own risk by constructing their own portfolio. But if you're looking for a simple 85% solution to your investment, Vanguard Target Retirement Funds are a great option. When you go to Vanguard's Target Retirement Fund website, you'll find 12 different funds there. You just need to select the one based on your estimated retirement year, let's say age 65. For me, that would be Target Retirement Fund 2045, VTIAX. The expense ratio on these funds range from 0.12% to 0.15%. Slightly higher than other Vanguard funds, but still pretty good nonetheless compared to actively managed funds that could charge you anywhere from 0.5 to 2%. And with the extra expense ratio, they take care of the work of asset allocation for you. There is a minimum of $1,000, but unlike other funds we'll review here in a bit, there is no ETF equivalent. This is a set it and forget it type of option, so it makes sense that there is no ETF equivalent, since someone investing in target retirement funds are likely not looking for flexibility that ETFs provide and would want to automate their investments. If you want to make good investment decisions but want to spend the least amount of time as possible on it, I highly recommend Vanguard's Target Retirement Fund. You can literally set it up once in your life and check it when you're ready to retire. It's that easy. And if you'd like to jumpstart your money mastery today, download your free copy of San Generation's Guide to Financial Security, 10 Steps to Securing Your Family's Financial Future from my website at financialtortoise.com. I'll also have a link in the description below. Number 2 on our list is the Vanguard Total Stock Market Index Fund, VTSAX. An ETF equivalent is Vanguard Total Stock Market ETF, VTI. If you want to learn more about the difference between index funds and ETFs, check out my video here where I go more in depth. There is no wrong choice here, just the one that works best for you based on your priorities. VTSAX has an expense ratio of 0.04% and a minimum investment of $3,000. It's actually my personal favorite fund for equities holding because it holds every publicly traded company in the United States. At the time of this video, there are approximately 4,000 companies being represented in this fund. When you hold on to VTSAX, you're essentially purchasing a share of every publicly company in the United States. Companies like Apple, Tesla, and JP Morgan. And when you invest in a fund like VTSAX, you're believing that the US companies will continue to create value to its customers in the upcoming years. No one has a magic ball to predict the future, but if you're just to take a look at the past 10 years, VTSAX had an amazing return of 6.3% annually. Given the compounding of these returns, if you had put in $10,000 10 years ago into VTSAX, it would have grown to $45,000 today. Not bad for just buying and holding. Another great benefit of investing in a fund like VTSAX is the fact that the fund is self-cleansing. What do I mean by this? There are approximately 4,000 companies in this fund, and throughout our lifetime, many will go bankrupt and disappear. However, new companies will come and take its place in the fund. And here is the upside of this mechanism. While the worst possible performance a stock can deliver is 0, when they go bankrupt and disappear from your VTSAX, the upward potential is limitless. The best performance a company can deliver isn't 100%. It can be 1,000% or 10,000% or even more. Take a look at Tesla. Take a look at its growth in the last 10 years, 24,000%. If you hold on to VTSAX, you get the unlimited upside of companies like Tesla. During these 10 years, there have been many other electric car companies that have faded away and disappeared. VTSAX automatically replaced these dead and dying from its fund with new and upcoming companies with great potential. This is what is called self-cleansing and why it's so awesome. If you're ready to graduate from target retirement funds, I highly recommend holding VTSAX as your core wealth building fund to grow your net worth. Number 3 on our list is Vanguard Total Bond Market Index Fund, VBTLX. An ETF equivalent is Vanguard Total Bond Market ETF, BND. VBTLX has an expense ratio of 0.5% and a minimum investment requirement of $3,000. If VTSAX is your ambitious risk-taking inner self, VBTLX is the calm, steady inner voice. To be successful in life, you need a bit of both. VTSAX will build wealth, but VBTLX will help smooth the ride so you aren't having a heart attack every time the market takes a dip. You might be asking, what the heck is a bond and how are they different from stocks? Simply, bonds are loans. When you're buying bonds, you're essentially loaning money to a company or a government agency. In contrast, when you're buying stocks, you're buying a part ownership in a company. And unlike stocks, they're much less volatile, which makes them a good addition to our portfolio to smooth out the rides. In addition, bonds most often move in opposite directions to stocks, so they can act as your counterweight to stocks depending on how the market is doing. When holding bonds, holding VBTLX, in my opinion, is really your best option given that you minimize the risk of individual bonds. Risks such as default, interest rate, and inflation risks. With VBTLX, you're essentially holding 10,000 individual bonds within this one fund. Start adding them to your portfolio as you get closer to your retirement age, or if you want to taper back some of your total portfolio risk, you can start adding them sooner. The percentage of your total portfolio will be based on the risk tolerance, but you can also check out my video on asset allocation here to get some real-world examples. All right, number 4 on our list is Vanguard Total International Stock Index Fund, VTIAX. An ETF equivalent is Vanguard Total International Stock ETF, VXUS. VTIAX has an expense ratio of 0.11% and, like many other Vanguard funds, has a minimum investment requirement of $3,000. What VTIAX will do is provide you exposure to the international market outside of the US companies. Companies like Taiwan Semiconductor, Samsung, and Alibaba. In total, approximately 8,000 companies. That said, in today's global economy, countries and companies are more integrated today than ever before. Big companies don't operate in isolation from the rest of the world. Just look back at the recession of 2008. It's most often referred to as the global financial crisis, not just a US crisis. What happened with the US housing market had a ripple effect across the globe because our markets and companies are now so tightly integrated. US companies are no longer exclusively US companies. They're international corporations. For most of them, a good chunk of their profits are actually generated outside of the United States. Just look at Apple, the biggest US company based on market capitalization. As of the second quarter of the fiscal year 2021, 67% of Apple's total revenue was generated from outside the United States. What this means is that when you hold on to total stock market index fund like VTSAX, you're already getting quite a good exposure to the international markets. Growth in countries like China and South Korea is already being reflected in the US companies like Apple, who are selling their latest iPhones overseas. That said, if you still like additional exposure to the international market by investing in non-US companies, VTIAX is a great fund to hold. Vanguard already makes them automatic in their targeted retirement funds, which shows that they believe additional exposure to the international companies is a smart option. I personally wouldn't make it a core holding in your portfolio, but a minor percentage is a good option. It also sounds really cool to say that you're invested in international companies like Alibaba and Samsung when you're talking to your friends. For our number 5 on the list, I'm going to cheat a bit and group 3 funds together. The Vanguard 500 Index Fund, VFIAX, Vanguard Mid Cap Index Fund, VIMAX, and Vanguard Small Cap Index Fund, VSMAX. All 3 have a minimum investment requirement of $3,000. VFIAX has an expense ratio of 0.04%, while VIMAX and VSMAX has an expense ratio of 0.05%. VFIAX represents the 500 largest publicly traded companies in the US. VIMAX has 374 what finance people call mid-cap companies. I'll explain more in a bit. VSMAX has close to 1,600 small cap companies, and all 3 have ETF equivalents. Vanguard S&P 500 ETF, VOO, Vanguard Mid Cap ETF, VO, and Vanguard Small Cap ETF, VB. These 3 funds combined are a great alternative to the Total Stock Market Index Fund, the VTSAX, if you like even more control over your asset allocation. In the finance world, companies get categorized based on the size of their market value. Large cap, mid cap, and small cap. Large cap companies are companies valued more than $10 billion. Mid cap companies are companies valued between $2 billion and $10 billion. and small cap companies are valued between $300 million and $2 billion. As you can imagine, different sized companies operate differently and therefore likely affect their future performance. A big company might not have the aggressive growth trajectory like a small startup. Though this is hard to predict given many of the large companies these days are tech companies, and they move at their own pace regardless of their size. Nonetheless, when you hold VTSAX, you're holding on to all three different categories of companies. However, because of market capitalization, the percentage of small cap to mid cap companies' representation is pretty limited. No more than 10 to 15% total. So if you like to hold more small cap to mid cap companies in your portfolio, these three funds combined can give you that flexibility. VIFAX can represent your large cap holdings, VIMAX your mid cap, and VSMAX your small cap. Or you can have it the other way around. If you want more large cap companies compared to what VTSAX provides, focus more on VFIAX and less on small to mid cap company funds. If you found value from this video, please hit the like button, and if you'd like to learn more specifically the difference between VTSAX and VFIAX, the total market versus S&P 500, check out my video here. Thank you, and I'll see you in my next video.